Hi everyone, today our group will be presenting a tax planning case involving United Holding Group Sendirian Berhad, focusing on how tax incentive and planning strategy can be used to optimize the group tax position. First, United Holding Group is a Malaysian tax resident investment holding company with two wholly owned subsidiaries. The first one is UHT. It is the manufacturing subsidiary producing medical and surgical supplies, while UHPS is the group in-house research and development company. All companies close their financial year on 31st December. In 2025, UHT plans a 26 million expansion into promoted surgical device manufacturing, with production commencing in July 2025. The investment including new factory buildings for production purpose and warehouse storage purpose, and also including new plant and machinery. Following the expansion, UHT is projected to generate increasing adjusted profit from YA 2025 onwards. In contrast, UHPS continued to incur adjusted losses due to its exclusive in-house research and development activity and lack of third-party revenue. In addition, the group earns interest income and also rental income, while both UHT and UHPS are financed through bank borrowings. Next, UHT has incurred significant capital expenditure on plant and machinery, including automated and secondary machinery, which give rise to capital allowance and automation incentive considerations. UHT also invested in green technology assets, including the solar PV system and also electric vehicle truck, which are approved for the green investment tax allowance purpose. So what are the problem statements? First, whether UHT qualifies for pioneer status, reinvestment allowance, accelerated capital allowance, green investment tax allowance, or a combination, and which option maximizes tax saving. Second, whether UHPS losers should be surrendered under group relief or whether research and development tax incentive should instead be pursued. Third, as the group comprises 3 Malaysian tax resident entities with different income sources and capital structure, it is necessary to compute the chargeable income for each entity. And finally, the group must also assess its e-invoicing obligation, implementation timeline, and also compliance risk.
So our analytical approaches consists of 3 main components. First, we compute the chargeable income for both UHT and also UHPS as a baseline references, and secondly, we evaluate the key incentive from the year 2025 to 2029 to maximize their tax incentive, and lastly, we assess the indirect tax or compliance factor to minimize their regulatory risk. On this slide shows the baseline tax computations for UHT from the year 2025 to 2029, which also serves as a reference point for us to evaluate the impact of the other tax incentive. So UHT adjusted income is increasing steadily over the period because of the business expansions, and the total capital allowances included of the IBA and also capital allowances. In year 2025, it has a high amount because it includes both initial and also annual allowances. So after deducting the capital allowances, the chargeable income rises from 4.76 million to 43.77 million, and the tax payable is charged at the rate of 24%. So this baseline computation is very important to us because it allows us to compare the tax payable under different incentive scenario, and will give a clear view on how do we evaluate which tax planning strategy produces the most significant savings. Okay, again, it is a tax calculation, but for UHPS, since UHPS continues to incur R&D related business losses, and even it has the interest or rental income, but they're very minimal. After deducting the interest expenses, the aggregate income is negative, so there is no tax payable. Although group relief under Section 44A is available, but losses are not surrendered as UHT already benefits from the pioneer status that will be covered later on in details, so UHPS retained its losses for further utilizations. Alright, this is the overview slide on the tax incentive we considered or we applied. So for UHT, there are 4 incentives that have been our review, which is the first one is reinvestment allowances. It's considered because it has investment in automatic productions machinery. And besides reinvestment allowances, we also consider about the pioneer status because they are manufacturing and promoted products and has made very significant capital investment. And GITA applies again because it invested in approvable green technologies asset under Mine Hijau framework. ACA is reviewed, but it's not applicable, but since there's no qualifying ICT expenditure. For UHPS, there's only one, which is the R&D incentive is relevant, but because UHPS is having ongoing losses and no statutory income, so it cannot be utilized at this stage yet. This slide summarizes the tax savings under the different incentive options evaluated for UHT throughout the 5 years. So the comparison shows clearly the differences in both the amount and also sustainable for the tax benefits. Reinvestment allowances and GITA only limited, or we do say is a very short-term saving, while ACE is not applicable in this case. So in our conclusion, we would say that the pioneer status generate the substantial and also consistent tax saving throughout the 5-year incentive period, with a cumulative saving of 6.56 million. So therefore, we select pioneer status as a preference tax incentive as it delivers the higher tax savings.
Now we look at sales and service tax. A manufacturer is required to register if taxable sales exceed 500,000 ringgit within 12 months. UHT projected sales growth from YA 2025 to 2029 is expected to exceed. Therefore, UHT must register as a registered manufacturer under SST. Although UHT operates in the program-free zone, where the exports are SST exempt, the domestic supplies including sales to the MOH government hospital are treated as imports into the principal custom area and are taxable. After the registration, UHT must issue SST-compliant invoices, submit SST returns, and maintain proper records to avoid penalties while still being benefit from FTZ exemption. Next, under the IRB invoicing timeline, the companies are classified based on the annual revenue. UHT operates multiple business lines, indicating significant group revenue. As such, the group is likely to fall under Phase 1, requiring mandatory adoption from the 1st of August 2024. Even if the threshold is not clearly made, early adoption is strategically beneficial, especially for a manufacturing group with high invoice volumes. To comply, UHG must integrate ERP with MyInvoice, standardize the invoice data, redesign the workflow, staff training, and proper invoice retention. Early preparation reduces the compliance risk and ensures the smooth implementation. To conclude, the key tax findings for United Holding Group for YA 2025 to 2029 are as follows. For tax incentive, UHT qualifies for several incentives, but pioneer status is the most beneficial, generating approximately 6.56 million in tax savings. For UHPS, the company incurs continuous in-house R&D losses. Although the R&D deductions and group relief are available, there is no immediate tax benefit, and the surrendering losses is not recommended due to the UHT pioneer status. From an SST perspective, UHT is expected to exceed 500,000 ringgit threshold. While the FTZ exports are exempt, the domestic sales remain taxable. Finally, regarding the e-invoicing, the group must comply with the IRB phase implementation. The early ERP integration helps to reduce the compliance and operational risk. Overall, these findings support tax efficiency, regulatory compliance, and the group future expansion.
Now I would like to highlight the key findings and comparison the tax incentive package assessed for United Health Type Sustainable Hunt or UHT. So firstly, the analysis clearly shows that the pioneer status is the most tax effective and strategically beneficial incentive for the years of assessment 2025 to 2029. So this is mainly due to its income-based structure where only 30% of statutory income is subject to tax. Unlike the capital allowance incentive, pioneer status provides a stable and predictable stream of tax savings, which increases its UHT profitability growth. So this aligns well with the Malaysian objective or policy objective of supporting companies during their growth and scaling phase. In comparison, the investment allowance only provides a benefit when the investment takes place. So once the capital expenditure slow, the tax benefit diminish, show that the investment allowance functions more as a temporary incentive rather than long-term tax shelter. Similarly, for GITA that offers strong upfront relief but its impact becomes less significant when green investments level are small relative to UHT expanding profit space. So this indicates that GITA serve more as environmental policies enabler rather than a sustained income protection tools. So the net of applicability of ACE also consistent with statutory requirements, although future ERP-related investments such as like MyInvoice may offer planning opportunities if properly substantiated. Overall, this finding reinforce that effective tax planning is not about chasing every incentive, but about using the right incentive at the right time, guided by compliance, ethical responsibility, and long-term sustainability.
Now, some recommendations for UHT's tax planning strategies. First, UHT should proceed with pioneer status. This recommendation will offer superior long-term tax efficiency compared to capital expenditure-based incentives, such as a reinvestment allowance. Secondly, although UHPS is eligible to surrender its current year loss under group relief, they ought to retain the losses because UHT's taxable income has already been significantly reduced under the pioneer status. Next, to mitigate risk, the group should maintain a comprehensive documentation for all tax incentives claimed, such as by collecting clear evidence of qualified activities. They should also implement robust SST controls, given its operation within a free trade zone, such as by practicing proper segregation between domestic and export sales. UHT should also ensure full integration of its ERP system with the MyInvoice platform in tandem with national policy, like strengthening technical staff training and internal controls. At the policy and practice level, company policymakers can introduce a phased incentives transition mechanism so that the company can transition smoothly between tax plans to prevent a sudden tax cliff where companies change abruptly from partial exemption to full taxation. It should also consider institutionalizing tax planning as part of its strategic decision-making process in the company. Before we end our presentation, we can conclude that pioneer status provides the most significant and sustainable tax benefit for UHT. And although group relief is legally available, not all tax relief should be maximized simultaneously because that would yield limited benefit, reflecting prudent tax planning that considers timing and long-term outcomes. Lastly, effective tax planning can, to a high degree, reduce the company's exposure to penalties, audit risk, and increase operational fluidity. That's all from us. Thank you for listening.